If you keep trading the way that you do right now, you will never be consistent. Not because you're stupid, but because the market punishes the exact behavior that you repeat every single day. So today, I'm breaking down the 5-day trading secrets that most traders never figure out, and most trading gurus won't tell you because they don't even know it themselves. And if you watch till the end of this video, I'll give you the exact sniper entry checklist that I, the multi-millionaire trader, use every single day. My name is Brad Goh and I've been trading for nearly 7 years. And this year alone, I've already crossed over $1.8 million in trading profits. Every single trade documented live on my second channel, Brad Trades. I've also coached hundreds of students to become 6-figure funded traders. And I'm also the founder of EdgeFlow, the trading super app that is built for discipline and consistency. So quite simply put, I'm not some 18-year-old kid from, I don't know, fucking Wyoming who have no idea what he's talking about, just talking out of his ass. Anyways, I don't want your money. I want you to become a better trader. So let's get straight into it. The first thing you need to understand is how the market works or why price move. And the thing is, the market doesn't move because of your stupid indicators, news, or emotion. It only moves for 2 reasons. So that it can take liquidity and it can rebalance price. Alright, so 2 things, liquidity and imbalance. That's it. So most traders, when they look at a chart just like this, they see such a large amount of selling pressure in the market, and they automatically assume that this entire move begins at the candle that looks aggressive. It could be this one, it could be this one right here, or this one right here, but that's not true. Because the real move started way earlier. It started at the liquidity sweep and the structural shift that nobody was paying attention to. And here's exactly what I mean. Over here, when price went up there, comes down, goes up, comes down. What do we have? We got equal highs. And a lot of retail traders, they see this as a double top, whatever bullshit chart pattern, and they start entering for a sell right here, and they place their stop loss above this highs itself. And when that actually happens, guess what? There is a bunch of available liquidity being built up above those highs, because that's where they are placing their stop loss if they actually enter for a sell right here. And then later on, smart money manipulate price and cause price to come up there, swept all the liquidity, right? Stopped out all the retail traders before starting to push the price down. So this is where we have what we call a liquidity sweep, right? Where price actually went up there and took out this equal highs right here, right? Took out all of this good old juicy liquidity. Now forgive my awesome drawings, but anyways, when that actually happens, guess what? This is what I call the origin candle, right? This is the candle that led to the liquidity sweep, and this is the candle that led to price using the available liquidity to fuel price to come down here. Which also means that this is the first time institutions actually step into the market to enter for a sell position, to enter for like a large amount of sell positions. So this means that this is actually the origin point of this entire move, right? Like the reason why there's like a huge massive sell-off right here is because of the fact that earlier on, right, a few hours before this move actually happens, like 2 hours to be exact, what happened was that price went up there, stopped out all the retail traders, swept all the available liquidity, and now we got all the selling pressure, now we got all the sell orders that is sufficient enough to actually cause price to move to the downside, right? So later on, what happened is that price came down, pulls back to the same exact price point that swept liquidity. Like I said, this is the first time institutions actually entered for a sell position, mitigate that supply zone that was created from like this liquidity sweep right here, come down, and guess what? It actually led to a structural break where price came down and took out this last internal low that we have right here, which means that there is a lot of sell orders. Because bear in mind, it requires a lot of money in order for price to actually break structure. And that's exactly what happened right here. Price mitigate this supply zone that was created because of this liquidity, right? And then price came down, took structure before later on price went up there. Guess what? Do another liquidity sweep, right? Price came up here, swept the liquidity above this high right here, and then started pushing the price all the way down here, right? So this was like the first origin candle, right? The first time institutions actually step into the market. And then this could potentially be the second time, right? After it came up here and swept the available liquidity above this swing high that we have right here. Man, I feel like a freaking scientist right now with all of these messy drawings. Anyways, let me just like clean up everything a little bit so that you guys can really look at what's going on here. So that's pretty much how liquidity works, right? You must understand that price will always gravitate towards liquidity, right? It always move from one liquidity point to the next liquidity point. It always have to sweep available liquidity before the real move actually happens. So in this particular case itself, price pretty much swept the available liquidity above this highs right here to cause this move to happen. And then later on, price came up there, mitigate this previous supply, right? Came down here, right? But then there was insufficient liquidity for price to just continue collapsing. So as a result, it needs to grab more liquidity. And where does price grab more liquidity? It needs to build up some available liquidity above the swing high, you know, for like the retail traders who enter for a sell right here. And they also place their stop loss above these highs, generating the liquidity. And then later on, price went up there, swept that liquidity before the real move actually happens. Right? And this is what I mean when I say that the price is actively trying to take liquidity and to rebalance price. Because right after price sweep liquidity, right, notice how we have this huge imbalance in price. Price just start going down without any significant pullback whatsoever. And when there's such a huge amount of imbalance, understand that it will not last forever. Eventually, the market will start consolidating again, right? Try to seek fair value, try to rebalance, right, before it goes on to like the next period of imbalance, right, before it start dumping again. And that's how the market moved. The market moved from imbalance to balance to imbalance to balance. Balenciaga. So when you misread this, you end up chasing entries that were never yours to take. Like you start entering for a sell, like, I don't know, somewhere right here when price is in the middle of nowhere because you don't understand how the market actually works. But when you start to read it correctly, right, you understand liquidity, you understand imbalance. Now you are waiting very patiently for price to sweep liquidity, waiting for confirmations that institutions have stepped into the market. Then you enter for a sell position, right? You start trading like a freaking sniper instead of a professional gambler. And like I said, man, this is just how the market works, bro. Like price will always hunt liquidity, just like this, create huge amount of displacement in one direction, which is what we call imbalance. And then later on, you will notice that price will return to fill up all of this imbalance right here, right? You can see what happened was that after we have this huge dump to the downside, price start going back up, right? Actively trying to seek fair value, filling up all of this imbalance that we have on the left-hand side right here. And then once that actually happens, we can potentially prepare for like the next dump to the downside, right? The next imbalance. So it will look something like this, right? Try to seek balance again, and then later on, once it have found fair value, once there's sufficient liquidity, once there is, once again, your liquidity sweep, right? Once there is sufficient selling orders in the market, price is going to go for like the huge dump again, right? Have like a huge selling pressure, step into the market again. That's just how the market works. That's when the real move begins, right? Not here in the freaking of nowhere in freaking Wyoming, but here once liquidity has been swept, once there is sufficient sell orders in the market itself. Anyways, if you look at this entire beautiful drawing that I've marked up right here, this masterpiece, you must understand that this is not a pattern. This is programmed market behavior. And what this shows is that the market is simply just clearing orders, rebalancing inefficiency, imbalance, and then expands. And your job here is not to try to predict price, but rather to understand this flow, understand this institutional flow of money, understand this war between buyers and sellers, understand who is in control of price, and just trade with it rather than trying to fight it. So remember this. You stop losing the moment you stop reacting to random stupid candlestick and chart patterns, and you start reacting to liquidity and imbalance. So the next juicy secret I'm going to be talking about is the relationship between the three types of time frames, right? The three types of time frames that you should be using. So this is what we call the multi-time frame analysis, which involves you analyzing the charts from a higher time frame all the way down to a lower time frame. So if multi-time frame analysis or top-down analysis or whatever name you like to call it has ever confused you, let me just simplify everything, right? Let me just break it down in a way where like a freaking 3-year-old toddler can understand. The first thing you must understand is that you want to think of the time frames like a military chain of command. So back in the military, if you want to report something, you don't go straight away to the freaking 4-star general and tell him. No, You as a trooper, you tell your sergeant, and then your sergeant tells his officer, and then the officer tells the captain, and then the captain tells the higher up. So it has to flow in like this particular order. Like I said, you never ever skip the chain of command. You don't go from telling your sergeant to telling the freaking 4-star general. He's gonna slap you in the face, right? Yeah, anyways, that's pretty much the same sequence that you want to be using for time frames, right? You don't ever just skip from one time frame to the other without any purpose. It's like trying to read different books at one time. You are not going to understand how price work. You need to have a very systematic and structured framework in terms of how you analyze the charts. And to me, that just involves 3 time frames: your higher time frame, your medium time frame, and your lower time frame. And depending on your trading style, whether that's a scalper or swing trader or day trader or position trader or long-term investor, whatever, you will all have 3 different time frames. But you will all be using just these 3 set of time frames, right? Does that make sense? Like you only use higher time frame, medium time frame, and lower time frame. But the time frame within each one of this domain is going to be different depending on your trading style. For example, as a day trader, I'm going to be using, let's say, the daily time frame as my higher time frame, the 4-hour as my medium time frame, and the 1 hour or the 15-minute as my lower time frame. But then for a swing trader, I might be using the weekly time frame as my higher time frame, the 4-hour as my medium time frame, the 1 hour as my lower time frame. And then if I'm a scalper, I might be using, say, the 1 hour as my higher time frame, the 15-minute as my medium time frame, and the 1 minute as my lower time frame, right? So it really depends on your trading style. You have to make sure that you choose the time frames that is right for you. So let's break it down one by one. Let's talk about the higher time frame. So the higher time frame is used to build a narrative. It's used to identify a trend direction. It's used to define your market structure. Quite simply put, this is the big picture. This is where you are able to understand where the market is actually going. Are we bullish? Are we bearish? Are we in a range? Are we going to be looking for longs or shorts, right? What is our daily bias? And where is like the major liquidity the market is reaching out for? Once again, if you get this wrong, nothing else matters. You can have the perfect sniper entry, but if you're not trading with your higher time frame, or rather you are not taking into account your higher time frame, you're just going to be running into the walls and you will just be very super confused and overwhelmed. So start always by using the higher time frame. So right now, let's say I'm a day trader, right? So as a result, I'm going to be looking at the daily time frame as my higher time frame. So over here, I'm asking myself, okay, what is price doing right now? What's the objective of price? And quite simply put, it's going up, right? Like if you don't think price is going up right now, you're either blind or you're colorblind or you're just stupid, all right? But yeah, price is going up. But the thing is, okay, cool, Brad, like that is not a useful information, right? So you want to make sure that you do your proper mapping process, right? So over here, we see price is creating higher highs, higher lows, higher highs, higher lows, right? So we know that this is the last break of structure to the upside before later on price went up there and took out structural again, right? So this means that this is the last high low and this is the new high, which also means that we are able to map out our swing low, which is the most recent low, the lowest low that led to the most recent break of structure, and our swing high, which is the highest high that led to price starting to pull back. Right? Just by doing this alone, we have mapped out our swing range, which is this high right here and this low right here. And this is what we want to focus on, right? We don't care about what price did freaking decades ago or like freaking years ago. No, we just care about what price is doing right now. And in order for you to understand what price is doing right now, you have to first map out your structure. You have to first map out your swing range. All right, now that we have mapped out our swing range and we have understood that price is in an uptrend, guess what? Right now, we want to actually look for longs, okay? Like obviously you want to buy since price is going up right now, right? But the thing is, you want to make sure that you wait for the perfect price point to actually enter for longs. Now, where's the perfect price point? It's not going to be up here, right? Because if you enter for a long right here, your stop loss must be below this low, which is quite far away, which is why you want to wait for price to start pulling back and all that good stuff. Pull back here, create like a new higher low, and this is where you look for longs to continue riding the move to the upside. Because when you do that, guess what? You enter for a buy at this higher low right here. You can place a stop loss below these lows, and this allows you to have very limited downside, right? And have very unlimited upside, or like a very big upside. And that's it. Like literally, like that's what you use the higher time frame for. You just use it to map out your swing range so you know exactly where should you focus your time and your attention on, and you also identify the trend direction and just overall come up with like a daily bias on what you're going to be doing on the other set of time frames. Next, you got your medium time frame. Now for your medium time frame, like I said, I'm just gonna be looking in the eyes of like a day trader, which means that it's gonna be like, let's say the 4-hour time frame, right? So at the 4-hour time frame itself, this is where you want to do the exact same process, right? You can actually try to figure out what price is doing by looking at the structure, right? You can see over here, price was like going up, right? So this is the internal structure. Later on, price starts shifting bearish. Why did price shift bearish? Because it is simply facilitating the higher time frame pullback, right? So as we saw on the higher time frame, price has shifted bearish too, cause price to start pulling back, potentially creating like a new higher low right here before price start going up, right? So that's pretty much what we look at on the medium time frame itself. We look at the internal structure, we try to make some sense of the market, and this is where you can also be drawing your point of interest, right? Like your supply and demand zones, your order blocks, whatever. And quite simply put, this is where you refine your higher time frame trend direction. Just now, we have came up with a conclusion that we should enter for a buy. But the thing is, we don't know where to enter for a buy. And that's where the medium time frame is helpful. It allows you to identify the point of interest, like I said, the supply and demand zones, the freaking zones, support and resistance levels, whatever, that you want to wait for price to mitigate before you start entering for a buy. So for example, right here in this case, if I go down to the 4-hour time frame, I can see that there's a very clear as day like a demand zone right here. So there's a demand zone here. There's also like a bunch of other demand zones right here, which I'm not going to mark up, right? But anyways, you can see price is just pulling back to this previous demand zone, filling up some buy orders, right? Creating like a new high low right here before price continue pushing to the upside. So this is where, right? This is where we want to enter for a buy. So basically, once again, the medium time frame tells you when to trade and when not to trade. When to trade? Well, when price enters your supply and demand zone. When not to trade? Well, when price is not in your supply and demand zone. That's it, right? Like, don't need to overcomplicate things here. So you do nothing until price comes down to your medium time frame point of interest. Which brings us to the lower time frame. And we don't ever drop to the lower time frame until price mitigates your medium time frame point of interest. So over here, right here, price start putting back all the cool stuff, right? But it doesn't mitigate my point of interest. And since it doesn't mitigate my point of interest, I'm not going to be dropping down to my lower time frame. Okay, but let's say price has came down all the way down here to our point of interest. You know, it start collapsing heavily in the next few hours, and then it start coming down here and touch it. Once it touch it, the moment it touch it, boom, this is where I'm dropping down to my lower time frame, which could be the 15-minute or the 1 hour. Since I'm day trading, let me just use the 1 hour. And then this is where I want to look for my entry model, right? This is where I want to look for my entry confirmation to actually enter for a buy. I want to see the internal structure start shifting from bearish to bullish, right? To give me confirmation that, you know, the trend is officially shifting. And then this is where I'll potentially look for longs and like look to play the next move to the upside, right? This is where you wait for your market shift, your break of structure, the displacement, the liquidity sweep, the retest, and like this is really where we look for our sniper entries. So take note that we never ever use the lower time frame to try to predict the trend direction. The lower time frame is only used for executing trades with precision. That's it. And I think a lot of traders, they get destroyed because they flip between like different time frames at random times and places, and they try to like make some sense out of the market, and they can't, right? They just get super duper confused because once again, they don't have a clear process in terms of how to develop their daily bias, how to actually mark up their point of interest, and where to actually look to enter and exit. So quite simply put, the higher time frame determines the trend direction and the market structure. The medium time frame determines the point of interest where a reversal or continuation is likely, and the lower time frame determines the exact movement that the market commits, and that is where you want to enter for the trade. And when all three time frames agree with each other, right, like you come up with like a logical and rational bias, the trade becomes obvious. But when they don't, right, that is where you start getting confused and you start forcing a trade that just simply doesn't exist. Trust me, bro, like this one mindset shift alone, or rather like the shift on how you look at the markets, it will delete half of your losing trades. Because like I always say, the hard thing about trading isn't spotting A+ setups, it's an ignoring everything else. which is why it's so important for you to understand this mapping process so you don't just know when to trade, but when not to trade. So the next juicy secret that I'm going to be talking about is premium and discount, right? So this is such a simple thing to do, but it really makes a huge difference if you understand how to use this majestic tool. Now, what is the premium and discount tool? Basically, you just go to Fib retracement right here, and you just copy my settings, right? So please go and set up your tool first, right? So yeah, just copy my settings right here. Now, what we have on the top is premium. Right? And what we have below the equilibrium, the 0.5 line right here, is your discount, right? So this is premium and this is discount. And what this basically means is that when price gets all the way up here to the premium pricing, this means that price is most likely overbought and it's gonna start selling off. And then when price comes down to the discount pricing, this means that price is most likely oversold and it's most likely gonna start rallying. Right, so whenever price comes down to the discount, this is where we know that there's at any point of time right now, price could just reverse and start going up. Same thing when price come up to the premium, it could just reverse and start going down. And this is useful in very specific circumstances, especially when you are trying to figure out when price is gonna finish the pullback phase, when price is gonna continue with the overall trend direction. Like using this example right here, you can see price came down, pulls back, goes down, pulls back, and start going down and break structural, right? So this is the last internal break of structural, which means that this is our swing range. And the minute you start getting price pulling back just like this, what you can do is to take out your premium and discount tool, and then you basically just want to be plotting it at the swing high all the way down to the swing low just like this. Right, once that is done, you drag it all the way up to the right hand side. And like I said, this is your swing range, and this is your premium, and this is your discount. Which means that right now, price is going to be pulling back to the premium pricing. And we can expect price to start shifting bearish the minute it mitigates some form of supply zone within the premium pricing itself. So over here, if you look at the left hand side, there is a supply zone that we can mark up right here, and then there is another supply zone at the extreme swing high right here. And ideally, as traders who want to trade with the trend, right, let's say I want to enter for a sell right here, I don't want to be entering sell at like a random basis just like this or this. No, I want to wait for price to pull back to the premium pricing. And not just do I want to wait for price to pull back to the premium pricing, which is above the equilibrium, above the 0.5% line, I also want to wait for price to mitigate some form of supply zone that is within the premium pricing itself. And that's exactly what price did, right? Price is potentially pulling back up to this supply zone, and if there's sufficient supply at this supply zone, if there's sufficient sell orders, price is just gonna start crashing down, create like a new lower high, and take out structural and just continue this lower high and lower low dynamic. But if that does not happen, what we will see is price is just going to continue going up, right? Mitigate this extreme supply zone right here within, once again, the premium pricing, and start pushing down, right? So these are like the defense lines that has to hold in order for price to remain bearish. However, if price goes up there and take out this supply zone, take out this swing high, breaks out of the premium pricing, then yeah, price is reversing, right? We could potentially go from a bearish trend direction just like this to like a bullish trend direction where price is going to start creating higher highs and higher lows. So that's pretty much it. And a lot of retail traders, they try to enter for buys when price is in the premium pricing, or like enter for sells when price is in the discount pricing, without realizing that, like I said, you have to understand the delicate balance between the buyers and the sellers, right? And at any point of time, there is going to be a very less sell orders when price is in the discount pricing, which means that there is not going to be sufficient momentum and pressure for price to continue going down even further, which also means it's a stupid idea to actually enter for a sell when price is in the discount pricing, or enter for a buy when price is in the premium pricing. So the next secret is session behavior and volatility cycles. Now you must understand that every single trading session has its distinct volatility, timing, and personality. So in English, what it basically means is that price moves differently depending on the session that it is in, right? Depending on the time. So in the Forex market, there are 3 different types of sessions, right? There's your Asian session, your London session, and your New York session. So a lot of times, like I said, price, the currency pair that you're trading, is gonna have different movements or different sort of volatility and liquidity during that particular session itself. Like for example, in the case of EURUSD, you see that what happens in the London session is that it sweeps some liquidity, and then you have like this huge expansion move just like this. And then when New York session actually start coming in, it can either cause price to reverse tremendously, dramatically, or it can cause price to continue with the trend direction that was established in the London session itself. So in this particular case, price was actually going up in the London session, right? After it swept some liquidity, whatever. And then later on, during the New York session, it continued with the London trend direction, which is bullish. It just continued going up. But then if you look at this case right here, on this particular day, London session was actually like starting to consolidating right here, like it was still going up from the Asian session. But then when New York session actually opened, it caused the entire price to start reversing from like a bullish trend direction just like this to becoming like a bearish trend direction. So that's the relationship between New York and London session. New York session can either cause the entire trend direction from London to actually reverse, or it can cause it to continue going. And then Asian session is usually like more of that quiet session where it just consolidated. There's like not much price movement, and it creates the trap, right? The liquidity that is needed for the London session to actually cause price to move in a very dramatic manner. Like for example, in this particular case itself, you can see Asian session start consolidating right here, right? Creating some good old juicy liquidity above its highs. And then later, before London session actually opens, price swept the liquidity and cause price to start going down. And then when New York session opens, price continue with the bearish trend direction that was established in the London session itself. So yeah, that's it, right? That's the secret right there. A lot of traders, they enter setups that only work in very specific sessions. And then they start blaming their strategy. Oh, why does the Asia sweep strategy not work in a New York session? Well, you're freaking trading the Asia sweep strategy at 9 p.m. Singapore time, which is not the Asian session, so no shit, it doesn't work, right? Like that shit works in the London session, not in the freaking New York session. And this is also why you can see like the same setup, right? Like the same entry model, it fails in Asian session, but it works really well in the New York or the London session. It's really because of the fact that it's not your strategy that is wrong. It's the timing that you are using the strategy that is wrong. You're just using it at the wrong time of the day itself. Now, the next secret that I'm going to expose is one that is one of the most misunderstood concepts in trading. And that is the relationship between internal range and external range. So you must understand that every single market is always operating within two ranges. Your external range, which is the macro structure, the higher time frame structure, and the internal range, which is the microstructure, which is the smaller structure that is forming inside it. And if you don't understand the relationship between these two, you're gonna be confused, right? You're just gonna be lost. And as a result, you're gonna be trying to buy because the internal structure says so, while neglecting the macro structure, which is the external range. And you end up just having price just go against you. And that's also why you get like faked out so often. Right, so using this example right here, let me just quickly explain what I basically mean. So if you look at this over here, we got price comes down, make a massive pullback, starts coming down, make a tiny pullback, comes down, tiny pullback, comes down, tiny pullback, and goes down just like this. So if you compare the size of this massive pullback to all of these tiny pullbacks that we have on the right hand side right here, you will see that it's night and day difference. So like you can see this pullback is like twice the size of like this minuscule pullback right here. Size really do matters in trading, okay? But this pretty much tells us what is the external range and what is the internal range. So to me, when I look at this, I can define this as like the significant pullback, right? So this is a significant pullback just like this. So this is obviously a break of structure to the downside. But then when price actually come down here, make a tiny pullback and go down just like this, I will not deem this as a break of structure or as an external break of structure. I will only deem this as an internal break of structure. This is simply the internal range just breaking, right? So this is your external break of structure. This is your internal break of structure. Later on, price comes down here, up here, pulls back to this previous supply zone, whatever, creates like a new lower high, comes down and took out internal structure again, right? Took out another internal range. Same thing like what we have right here. So this means that this entire thing right here is the external range. And whatever that we have in between, you know, like whatever minor break of structure over here, all of this is the internal range, which also means that right here, when price starts shifting bullish and take out the last lower high right here, right, take out the last low that was established by the last internal high, guess what? Do we think that the market is going to be shifting to bullish right now? No, it's just shifting bullish in the short term in the internal range so that it can actually facilitate the pullback on the higher time frame, you know, create like a new lower high right here and then start shifting bearish again, right? So we never ever assume that just because price broke structural, this means that the entire trend direction is going to reverse. No, price has just broke the internal lower high, which means that price is just shifting bullish in the short term to cause price to start pulling back. That's it. Which is why right now when we look at the external range, this is still the external high, this is still the external low. So the external range, we are still bearish. But if you look at the internal range, this is the last internal lower high, and then this is the last internal low. And internal lower low can be the same low as the external low. And what happened right here was that price went up there and took out the last internal lower high, which means that there is a market shift happening on the internal range, which means that the internal range is shifting bullish. Now, bear in mind that the external range is still bearish. The internal range only shifted bullish so that it can cause price to make a pullback so that it can create like a new lower high on the external range, like a new external high right here before price continue going down even further. That's why it shifted bullish in the short term, which means that price is still bearish on the external range, and we have to assume that to be the case until price actually took out the last external high. If price takes out the last external high right here, right, price come up there, take out this last external high, then yeah, potentially the external range, the external structure, whatever the fuck you like to call it, is going to be shifting bullish, and right now we are heading up. But if that does not happen, then we still have to assume that external range is bearish. So yes, you can enter for buy right here, right? But you want to make sure that you manage your expectation, right? You can potentially start looking for shorts once price mitigate, like the premium pricing that we have somewhere up here, like some form of supply zone right here. And like I said, this is like perhaps one of the most biggest mistakes that traders tend to make, or rather like amateur traders tend to make, which is simply just taking entry inside the internal range, thinking that it's part of like this higher time frame trend, when in reality it's like just like a tiny move in the grand scheme of things. And here you can see price just end up sweeping the internal range to continue the external range direction. This is why it's so important for you to understand whether you are inside an internal range or external range. Because if you don't, the market is going to reverse on you every single time. Like you can have the perfect entry, you can execute flawlessly, but then if you are still trading against your external range, it's not gonna work out. Alright, just like I promised, if you watch to the end of this video, I'm gonna give you like a freaking sniper entry trade plan on steroids by a freaking multi-trillionaire trader. And this is what I call the Brett's Juicy entry model. Alright, like this is the holy grail right here, man. Please buy my $997 course. Please buy my freaking Lux Maxing course. Anyways, this is it, man. Like if you watch to the end of this video, this is it. I've done like an entire video breaking down this entire strategy from top to bottom, right? But I'm just gonna like quickly explain the process right here in a few sentences, because I believe that if you cannot explain your trading system in 3 sentences, you don't have one. So just to summarize everything that you can see right here, basically, I identify my trend direction and my market structure on the higher time frame trend. And I look for my point of interest on the medium time frame trend. And I look for my refined entry model on the lower time frame. That's it. 3 sentences, just sum up this entire process right here. Right? But yeah, if you want the more detailed process, it's going to be right here. If you want the more detailed entry criteria, which is exactly what I look up for before I actually enter for the trade, it's right here. And all of this is on the trading super app that I'm building right now called Edgeflow, right? And you can see this is your edge. And the cool part is that when you are trading, you can literally look at your trading plan, right? You can map out your charting process while trading at the same time, right? This is like very cool feature to actually have. But anyways, you guys can join the waitlist and just get notified when we actually launch this awesome trading super app that I've been building for the past 10 months. And yeah, that's it, man. I'm just building the best trading tool out there, the best trading super app that replaces the 6 different apps that you're using right now. And it's all gonna be in one place called Edgeflow. Now, what I want you to do next is to watch this video where I explain every single part of this entire strategy, right? In detail, in depth, right? How I manage risk, how I enter trades, how I map out my charts, everything is in here, right? So go on there, click on this video to understand how this entire strategy works. I triple guarantee if you apply this strategy, it's gonna make you a freaking trillionaire, the Jerome Powell, and you're gonna start printing money, all right? And as always, remember, you're just one trade away. Go on, watch that freaking video right there, man.